Water is the new oil, and Xylem might be the company leading the charge. But after their latest earnings report, the question is clear. Is now the time to invest, or is the stock getting ahead of itself? In this video, we'll break down Xylem's Q2 2025 results, look at the risks, and see if XYL deserves a place in your portfolio. Launched in 2011 after being spun off by ITT, Xylem sells water-related engineered products and solutions. The firm designs water pumps, controls, and treatment equipment under various brands like Flygt and Godwin, supporting water infrastructure and applied water systems. It also provides smart meters, leak detection, and asset management services. Additionally, Xylem offers maintenance and environmental solutions, including filtration and reverse osmosis services. The firm's products are used in public utility, residential, commercial, agricultural, and industrial settings worldwide. The company currently offers a starting dividend yield of 1.11%, compared to its 5-year average of 1.17%. The price-to-earnings ratio is currently 30.4, slightly below its 5-year average of 32.3, but still above the industrial sector average of 22. The expected price range is between $123 and $150, and with the stock currently trading around $145, it appears to be fairly valued at this time. Xylem currently pays an annual dividend of $1.60, distributed on a quarterly basis. The next payment is scheduled for September 26th, and investors must own the stock by August 29th to be eligible for the dividend. The most recent dividend increase was 11.1%, compared to a 5-year average of 8.4% and a 10-year average of 10.9%. Despite being a relatively young company, Xylem has consistently paid and increased its dividend every year for the past 13 years. The earnings payout ratio is at a very healthy level of 32%, and over the past few years, we've seen a strong downward trend, despite the company continuing to raise its dividend at a rapid pace. A similar trend is visible in the free cash flow chart as well. Earnings per share has been growing steadily year over year. There was a slight dip during the past decade, most likely due to the impact of COVID-19 in 2020, though feel free to correct me in the comments if there was another reason. Free cash flow per share has also shown strong growth over the past 10 years. Looking ahead, EPS is expected to grow by 9% over the next 12 months. While the sales growth chart shows some volatility, the company has demonstrated strong growth overall. On the shares outstanding chart, there was a noticeable spike after 2022. That's because in May 2023, Xylem announced it would acquire Evoqua, a leading player in the water treatment industry, through an all-stock transaction. The deal was valued at approximately $7.5 billion, paid entirely in Xylem shares, which led to an increase in shares outstanding and shareholder dilution. So why was this deal worth it? Evoqua strategically complements Xylem's portfolio in the industrial and wastewater sectors. Management estimates over $140 million in annual synergies. The acquisition strengthens Xylem's position in the fast-growing water technology market tied to environmental sustainability. Importantly, the total sales chart reflects this acquisition-driven growth. That's crucial for long-term investors. If a company issues new shares, total sales must grow at a similar or faster rate to justify it. However, return on equity and return on invested capital have mostly been below desired levels in recent years. In contrast, both operating margin and free cash flow margin have shown a strong upward trend. Debt levels have been declining consistently since 2016, something all long-term investors appreciate, and the company's interest coverage ratio has been steadily increasing, another positive indicator of financial health. The company is currently available with a starting dividend yield of 1.11%. The most recent increase was 11.1%. And such rapid dividend growth is characteristic of the company. It holds a credit rating of BBB, which is still considered solid, and the dividend appears to be safe. Right now, the stock seems to be fairly valued, with strong growth potential. And with dividend increases like this, Xylem could offer a very attractive yield on cost over the next 10 to 20 years, making it an appealing long-term dividend growth play. Disclaimer: This video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video. Xylem delivered solid performance in Q2. Revenue came in at $2.3 billion, up 6% year-over-year, with 6% organic growth as well. Adjusted EPS was $1.26, a 16% jump from Q2 last year. Pricing and supply chain strategies helped offset inflation and tariffs. Management credited their simplification efforts for improving customer experience and driving stronger margins. Let's talk segments. All 4 segments reported revenue growth, with strong demand in measurement and control solutions and water solutions and services. Measurement and control saw 12% orders growth, but margins dipped slightly due to inflation. Slide 6. Water solutions and services showed 24.4% adjusted EBITDA margin, the highest among all units. Applied water and water infrastructure also delivered steady 4 to 5% organic growth. Adjusted EBITDA margin hit a record 21.8%, up 100 basis points year-over-year, a clear sign of execution strength. Free cash flow, however, declined to $169 million, mainly due to outsourced projects and timing of tax payments. Here's the big one. They raised full-year guidance. Revenue now expected at $8.9 to $9.0 billion, up from the previous $8.6 to $8.7 billion. Adjusted EPS raised to $4.70 to $4.85. An adjusted EBITDA margin forecasted at 21.7 to 22.2%. So despite tariff and inflation pressures, they're confident. Still, let's talk headwinds. Tariff exposure could total up to $160 million annually, but Xylem is managing most of it with pricing adjustments. Also worth noting, free cash flow remains under pressure, and future gains depend heavily on successful integration of acquisitions. Positives, strengths, and tailwinds. Xylem delivered a strong second quarter, with both revenue and adjusted EPS showing solid year-over-year growth, a clear sign that demand remains resilient across core markets. The company also achieved a record adjusted EBITDA margin of 21.8%, thanks to a combination of pricing discipline, operational efficiency, and productivity gains. One of the most encouraging signals was the upward revision of full-year guidance, which indicates that management is confident in the momentum carrying into the second half of 2025. That kind of transparency and forward-looking clarity is something investors love to see. Moreover, Xylem's simplification strategy is starting to pay off, helping streamline operations and improve customer satisfaction. This is not just about short-term wins, it's laying the groundwork for scalable long-term growth. Negatives, risks and weaknesses. That said, the report wasn't without some red flags. One major concern is Xylem's exposure to tariffs, especially with ongoing geopolitical uncertainty. The estimated annual impact of up to $160 million could weigh on margins if not fully offset by pricing and supply chain maneuvers. Another issue is free cash flow, which declined year-over-year, primarily due to outsourced water projects and timing of tax payments. While management framed this as temporary, it's still something investors will want to track closely in future quarters. Lastly, although margins improved overall, some segments did experience slight compression, particularly in areas impacted by inflation and unfavorable product mix. That indicates some underlying cost pressure still exists beneath the headline results. So should you invest in XYL? If you believe in the long-term potential of clean water, infrastructure investment, and digital metering tech, Xylem is positioned well. However, I'd watch how they manage tariffs and cash flow in the next 2 quarters before going all in. Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.